Thank you for joining this webinar presented by Citizens and Northern Bank. Our goal is to discuss the options available to people who have decisions to make regarding an employer's retirement plan. These decision points are occurring more and more these days. When leaving or changing jobs, often folks have accumulated retirement balances that they need to consider. People are making employment changes more frequently these days as well. As the slide states, the average worker today changes jobs 11 times between ages 18 and 46. The first thought that probably comes to mind is that someone leaves one job for another, or that person has been laid off. While those are common occurrences, changing the employers doesn't always mean that one has left his or her place of employment. In this day and age, many times one employer may be acquired by another and leave an employee with the same set of decisions that would otherwise be faced by someone who actually had quit their job. For various reasons, employers sometimes terminate their retirement plans. This also may be a result of one employer acquiring another, or it could be some other type of corporate restructure. Additionally, many employers who sponsor defined benefit plans, often referred to as traditional pensions, are terminating these plans in favor of a 401k or other defined contribution plan, which are less costly to the employer. And of course, an employee needs to make a choice of how to handle the decision that was the original reason for these plans in the first place: retirement.
By investing in your employer's retirement plan, you're already doing something great for yourself. You're saving for retirement. That's what your employer's retirement plan is all about. But what happens when you leave the company, or if your employer or your plan is undergoing changes that require a decision? What if you're now entering retirement or partial retirement? You're at an important crossroads. You need to decide what you're going to do with the money you've accumulated so far. This may be one of the most important financial decisions you will make in your entire life.
When you're faced with making a decision about an employer's plan, you basically have four choices. Stay in your former employer's retirement plan if allowed, cash out your balance altogether and pay whatever taxes and penalties may apply, move your money into your new employer's plan, or roll your money into an IRA. Making the choice that's right for you is a personal decision that will be driven by your particular situation and a close analysis of the pros and cons of each option. Let's take a look at these choices.
First, let's consider keeping your money in the employer's plan. Depending on the circumstances, your plan may actually allow you to leave your money where it is. Leaving your money where it is will keep it away from the tax man, at least until you withdraw it at retirement. Also, you can remain in the investments that you already know, and your former employer remains responsible for monitoring the investment options available to you. However, remember, you will still need to contact this employer for all of the information about the plan, any changes regarding record keeping or investment options included or removed, plan benefit specifics, etc. Also, remember that the employer can make certain changes to the plan that will affect you. For instance, the employer can change what company will administer the plan and what investment options are available to the employees. Many times, such changes can affect the employees and ex-employees' investment results and the fees their investments bear. If you decide to stay in your old plan, also keep in mind that you cannot make additional contributions and you must follow the old plan's rules for making exchanges and withdrawals. Further, if you have an outstanding loan balance, you'll want to see if your former employer's plan will accept loan repayments that are not made through payroll deductions.
Another option to you is to take the cash. So if taking the cash is an option, why do we call this option pay? Of all the options we'll discuss, this one may have the greatest financial consequences. Why? Because when you cash out, you actually end up paying money in income taxes and penalties. Keep in mind that the following taxes and penalties may be applied to your pre-tax retirement savings on withdrawal. 20% of your withdrawal will be withheld at the time of your distribution as federal income tax withholding. Then, when you file your taxes for the year, the amount withheld will be applied against your total income tax liability. The actual tax at that time is based on your personal tax rate, so you may owe more than was withheld. Finally, a 10% federal income tax penalty may be assessed if you separate from service prior to the year you turn 55 years old. Additionally, state income taxes may be applied. These taxes and penalties could take a big bite out of your overall account balance.
Here's your third option, moving your retirement plan balance into your new employer's plan. Of course, this is an option only if such a plan exists and if it allows such a move. Moving your before-tax account balance into an employer-sponsored plan keeps it away from the tax man, at least until you withdraw the money at retirement. Moving your account balance to your new employer's plan can help you consolidate your retirement savings in one place. Before you move your account balance into a new employer's plan, however, keep in mind that the new plan may offer fewer investment options than an IRA. There may also be plan-specific rules, such as a waiting period before you may move money into the plan, how often you can change your investment options, and withdrawal restrictions. If you have an outstanding loan with your current retirement plan, you'll want to check with your new employer to see if the loan can be rolled into the new plan as well. And don't forget, the new plan's options may change at the discretion of the employer.
Finally, we come to the most popular option, rolling the balance from your retirement plan into an individual retirement account, or IRA. There are two types of IRAs available, a traditional IRA and a Roth IRA. Each type has its own rules and benefits. We'll touch on some of them, but how they relate to your personal situation is a discussion best had directly with one of our professionals. At the end of this presentation, we will share our contact information so you can reach us to discuss this issue, as well as any other financial question you may have. Similar to moving to a new employer plan, a rollover into a traditional IRA is a non-taxable event that allows your money the opportunity to continue growing on a tax-deferred basis. You'll have to pay taxes when you finally take distributions. A rollover of pre-tax money into a Roth IRA is a taxable event at the time of the rollover, but distributions will not be taxed when a qualified withdrawal is taken. A traditional IRA can be a great way to consolidate retirement plan assets that may have been accumulated over the years at various employers. A great feature of an IRA is that it can accept rollovers from any plan, whereas not every employer plan will. Especially in this era of employees changing employers, corporate mergers, acquisitions and restructuring, and employers making changes to plans, having an IRA ready to consolidate retirement assets can significantly simplify your life. A major advantage of rolling over your retirement plan balance into an IRA is potential investment flexibility. IRAs generally offer you a greater selection of investments to choose from than a retirement plan. IRAs can be invested in everything from FDIC-insured bank deposits to mutual funds to annuities to stocks and bonds, and even alternative assets such as REITs or limited partnerships. Importantly, some of these options provide for income solutions that are very interesting and important to people entering retirement. These options are not available through the vast majority of employer-sponsored plans. Another issue that is of great importance to many people is the fact that with an IRA, no one else has any involvement with your retirement. Once the rollover is complete, you'll have no involvement with any employer, current or former, with respect to these assets. You can roll your money directly into a traditional IRA or a Roth IRA. If you have a Roth 401k or Roth 403b assets, they can be rolled into a Roth IRA, and this is not a taxable event. Also, if your circumstances are favorable, you can even convert a portion of all of a traditional IRA to a Roth at any time. As you can see, rolling to an IRA has an enormous amount of flexibility, privacy, and personalization. It's no wonder it's the most popular option. Let's take a moment to revisit the option of cashing out. This can be a very tempting option, especially for younger workers who may have many current needs and desires for which they could really use some extra money. Many times these folks may not have contributed very long or in a very large amount to the plan, so they don't think that cashing out is that big of a deal. But let's look at an example.
Consider Jim and Rachel. Jim and Rachel both make the same salary and save 8% of that salary for retirement each year. After 5 years of employment, they both experience a job change. Jim decides to cash out and spend his entire account balance of approximately $22,000. whereas Rachel decides to roll over her balance into an IRA. They then continue saving at the same rate until they retire after 40 years of employment. Look at the difference in their monthly withdrawals at retirement. Jim's decision to cash out way back at year 5 has cost him nearly $1,200 per month at retirement. Now, there may be some situations in which you really need the cash. If this is the case, consider withdrawing only what you absolutely need and rolling over the rest.
So, what should you do? Stay, pay, move, roll? To help you make this important decision, it might be a good idea to check out a tool located on the American Funds website. Visit AmericanFundsRetirement.com and type Spend or Save in the search box. The Spend It or Save It calculator can give you a realistic example of how taxes and penalties may impact a full distribution of your balance versus how your investments may continue to grow tax-deferred in, say, an IRA. Simply plug in your information, such as your current retirement plan balance, current age, and other factors, and let the calculator do the math. I think you'll find it an eye-opening experience.
We've spent time talking about the 4 choices you have when making decisions about your retirement plan. Stay in your former employer's plan, take a distribution and pay the appropriate taxes and penalties, move your money into a new employer's retirement plan, or roll into a traditional or Roth IRA. As you're thinking about what to do, consider these benefits: continued tax-advantaged savings, consolidation of your retirement account balances, and access to more investment choices. Which ones are most important to you? Keep in mind that the main point is to keep as much as possible invested in tax-deferred accounts in order to accumulate assets for retirement. No matter what you decide to do, unless you are planning to retire now, you should look for opportunities to continue to invest for retirement, either through a plan at work or on your own.
While we have covered the basic options available to people faced with making decisions about their retirement plan, you probably have been thinking about some details of your life for which you could use some advice. Questions like, when would a Roth IRA be a good choice for some or all of your retirement savings? What type of investment should I be using for my own situation? How can I guarantee an income in retirement? Those are just some of the common concerns we help people with regularly. Citizens in Northern is a place you can trust for answers to any financial questions you may have. We've been around for a long while, and we've seen a lot of changes in 150 years. We've built a reputation for trustworthiness, and that has led to growth. We are honored to have investment-related relationships totaling over $1 billion. Our professionals are located right here in the counties we serve, and they possess some highly esteemed credentials.
Just as important as our experience and our expertise, however, is the degree that our people truly care. We are your neighbors. We want you to be successful with your retirement decisions, whether you're 25, 45, or 85 years old. We want to do more than sell you a plan for your retirement. We want to walk with you on your financial journey, whatever that means to you. Let's walk the road together. Thank you for your consideration.